Joining us for a look at what investors should expect as we head closer to the election. Jeff DeGraff, technical analyst and chairman at Renaissance Macro Research. Mike also joins the conversation. Jeff, good to see you again. You've been looking at various charts for us. The first one is kind of how the market's been reacting to changes in the polls as we approach the election.
Yeah, well, I think it's interesting because people get hung up, and it's obviously very emotional. It always is, but it seems more emotional and more charged this year than probably any election year, at least in my lifetime, that I can remember. Yet the market's really good at sort of figuring out, I don't want to say the best case scenario. What it's really good at is discounting the worst case scenario. And, you can see here pretty clearly from the chart, which in red is the S&P, and the other line is the probability of the Democrats basically sweeping the House, the Senate, and the White House. And the S&P peaked at the point where the probability of that was the lowest. And since then, it's been creeping higher, the probability that is. And yet the S&P has sort of found its footing and said, okay, look, there's certain things here that we're not worried about. There's other things that maybe we are worried about, but the potential for stimulus and some other measures that the Democrats might bring to the table, I think, is what the market figures out. And it's the worst case scenario that gets priced in about a month before the actual election. And that's what we've been trying to focus our attention on for clients, is not to get too torn up or too wrapped up about the emotional charge in the election.
Wait, so Jeff, all of that worry that was out there around higher capital gains taxes and higher corporate taxes, which both would influence stock prices, you're saying that was already priced in and the markets looked past it to only good news?
Whatever the issue was, Sarah, was at least looked upon as something that might be a problem maybe down the road further, but the probability of something else coming in, and I would say it's probably stimulus, maybe it's more Fed, but that's what the market is saying, is that, hey, look, whatever that issue might be, that might be a 2021 issue, that might be a back half of 2021 issue. It's probably not something at the forefront, and the market is sniffing out something better in terms of its outlook for the economy and for obviously its share prices.
Your next chart looks at election year and election week volatility. What do you see there?
Yeah.
What does it mean?
Well, and that's part of this, right? So the volatility, you would normally think volatility goes up into the election. You can see that pretty clearly that happens, and it continues to go up. Historically, volatility would be associated with downside moves, but we disaggregated that and we looked at upside versus downside volatility. And without getting too complicated, what we really found was that the market's downside volatility peaks right about here. And the volatility that you see in terms of the increase is actually upside volatility. In other words, back to that point about the worst case scenario being priced in, upside good things tend to happen. Today might be a reflection of that, but good things tend to happen between now and the election, and actually through the election into the end of the year. And we find Sharpe ratios, Sortino ratios, all these things that measure risk-adjusted returns actually trough out about a month before the election. And so even though, again, it becomes very emotional, it actually is a very, very good time to sort of hold your nose and say, okay, whatever the case may be, the market's probably got it figured out, and I need to not wait until after the election to invest, but go into it and invest. And I know that seems counterintuitive, but that's absolutely what the data tells us.
Shepard Smith here. Thanks for watching CNBC on YouTube.